Welcome to the WealthWise Viewpoint. My name is Loreen Gilbert, CEO of WealthWise Financial. And with me is John Milligan, our Director of Investment Strategy here at WealthWise. And we're going to be talking about the first half of the year, what we've seen so far, and give you our mid-year outlook going forward from here.
Yeah, absolutely.
So with that, let's just talk about the first half of the year. John, it's been one of the most difficult first half of the years that certainly we've seen in our careers, and it really goes back to 1937 as far as being a difficult first half. So can you quantify that for us?
Yeah, well, we went back and we pulled figures for the S&P 500, which can be generated all the way back to the 1930s, and the Barclays Ag. And what we found is that for a 60-40 combination, 60% S&P 500, 40% Ag, this was the worst first half of the year since 1937.
And what made it especially difficult is, just like you said, you would expect difficult periods of times when you're 100% in equity, but rarely do both equities and fixed income go down precipitously at the same time like we had the first half of the year. Now the good news is, since then we've seen a rebound, and in fact since the lows of around June 16th, we've seen a rebound of over 14% on the S&P 500. So we have seen a rebound there. But let's talk about what does this really mean?
Yeah, well, it's kind of, I think, changed a lot of investors' viewpoints on things because in the modern era of, a Fed kind of semi-controlled market, there's been this idea that bonds have been a safe haven, that if you have a 60-40 portfolio where 40% of your portfolio is in bonds, when the equity market's crashing, people will run into bonds and that'll keep their price elevated and that they are a safe haven. Now, one of the things that supported bonds in the past is that the Fed's been more quick to act, and so when we looked at the years where the S&P 500 had a negative year, in the year the S&P 500 was down, in most recent decades, dot-com burst, 2008, we saw the Fed was acting in those years. So as the S&P 500 was going down, the Fed was lowering interest rates. When the Fed lowers interest rates, it raises the prices of bonds. So the idea that bonds being a safe haven as well as keeping them up, well, the Fed was also kind of keeping them up. But the Fed's facing a challenge that they haven't faced in a long time with inflation, which is preventing them from bringing bonds up. They actually have to do the opposite.
That, John, you want to talk a little bit about what we're seeing with inflation?
Yeah, absolutely. Well, so the Fed is being accused of being behind the curve on inflation, and that's what's caused. They believe that inflation spiking so much is going to cause the Fed to have to make a drastic maneuver. And the Fed really has two tools at their disposal. They have what they actually do, their actions that come out of the FOMC meetings, but they also have what they say. And what they say can be just as powerful a tool. And so, like Loreen's alluding to, they're keeping the language not extremely hawkish, but keeping the level up there until the smoke is cleared on a lot of those inflation measures. And we're starting to see inflation temper a little bit. We're seeing the futures pricing dated 3-6 months out on a lot of commodities starting to come over the hill a little bit and come down. Consumer expectations, which is extremely important, on both the 3 and 1 year measures, are also both moderating at pretty decent levels. And this is great. Short-term moderation, peaking in the past few months, that's great, but it doesn't make a trend. But what does give us more confidence is the fact that, something like CPI or PCE, they've got numerous components. They've got components that are services, that are, durable goods, that are gasoline, things like this. And we're seeing all of these kind of peak at different times. And we've seen some of these components peak as early as late 2021. So the Manheim Used Car Vehicle Index peaked in December, and washing machines and things like that, they peaked back then. And we've seen lumber peak in February, and then we've seen aluminum peak, I think, in March. And so we've had all these different items peak at different times. So it's kind of like we're just getting like waves of like different battalions of inflation. They come, they hit us, and they kind of subside. So that gives us a little bit of confidence that we'll get through each wave, and then we'll be kind of settled out of it.
And they've been staying down as well. So that's the important note, is that these factors that have peaked as they've come down, they've also stayed down. We haven't
Yeah.
seen them coming back up, so that gives us reason to believe that those parts have been transitory and they're coming down. However, there are going to be areas that are more sticky with inflation. We know what those areas are, like shelter.
Yeah, absolutely. So, we saw home prices increase a lot in 2021. And since we've actually seen home prices come down. But rent is a big part of the inflation indices, and rent tends to lag prices by about a year. So the prices on the values of real estate go up, and then over the course of about the next year, landlords, et cetera, then start to bake that into the prices of rent. They can't raise rent too quickly. But we've started to see home prices and values actually peak and start to come down. So down the road somewhere, that that level of inflation pressure is going to come off for rents as well. But I think we just hit our 17th month of consecutive rent increases, and I think this month the previous one was one of the biggest.
Yeah, and not only have we seen prices start to come down, but we've seen home sales come down significantly.
Yeah, mortgage indexes, home sales. We saw since I think it was 2006 a record of cancellations of home purchases. So pending home sales being canceled. So yeah, we've got it.
And all that is part of what the Fed is trying to do: slow down the economy so that it doesn't continue to grow so fast or inflate so fast, and that we continue to have inflation being embedded. And so the key point about what John was saying with inflation expectations coming down is critical, because if consumers expect inflation to continue, it is a domino effect, and they'll continue to purchase items today worrying about the price tomorrow. But that's what the Fed is trying to avoid.
Yeah, and the Fed is trying to engineer a soft landing, but they want to avoid certain things. So they want to avoid crashing the economy, and they also need to act to avoid other serious things like inflation keeping up, but the economy slowing down. One period that's very similar to what we're seeing now was like 1974. In 1974, we had a lot of similar type inflation, energy inflation, etc. And but growth was slow, and the Fed was slow to act. Relatively, they didn't raise interest rates that much. And inflation remained elevated for most of the 70s, and it dampened consumer spending, and really was kind of dragging the economy at all, and that's what we got known as stagflation.
And so the Federal Reserve is cognizant of that, trying to raise rates enough, slow down the economy without it turning into stagflation. So John, I've never seen a period of time where investors have talked more about recession before we're actually in a recession.
Yeah.
So let's address that. So first of all, when we talk about a recession, we used to define it as 2 consecutive quarters of negative GDP, which in fact we've had. However, the governmental organization that defines a recession, the NBER, changed the definition of a recession in the middle of the pandemic, because we didn't have 2 quarters of negative GDP, but we definitely were in a recession.
Yeah, and so they changed the definition to include things like employment factors, factors on like activity, like manufacturing indices, that type of stuff. How much durable goods are being produced and ordered, etc. And so I mean it makes sense to increase the breadth of it. And so one of the things that a lot of people have been inquiring or wondering about is, will the Fed be able to institute a soft landing as they raise rates to try to tamp down inflation?
Which means avoiding a recession. Soft landing versus hard landing, meaning we end up in a recession.
Yeah, it's trying to really thread that needle and get it at the right spot to calm down the economy enough to calm down inflation, but not cause things to come crashing down and create a snowball effect of layoffs, etc. And the interesting thing is that we reviewed a study recently that showed that we actually have like a somewhat control group of countries to look at and see, because the U.S. wasn't the first one to really start the rate hike cycle. And we're not the only ones, globally that are dealing with things like inflation. A lot of these conditions are similar across a lot of countries.
Like New Zealand started raising rates, about a year ago?
Yeah, New Zealand, Chile, Peru, Brazil, Poland. Yeah, there's a whole basket of countries that started raising rates about a year ago. And so we're we're a year out from that, and we're able to look and see what the result of it has been. And aside from Chile and Peru, the rest of the countries all look to be in great shape. Great unemployment, great GDP growth. Not like astronomically high numbers, but enough to say that we're very confident that they're not going into recession.
Right. However, the yield curve has inverted. So when we look at the 2 and the 10-year, this is one of the indicators that we look at that is inverted, which is a sign of a future recession. However, with the 2 and the 10-year inverting, it's typically anywhere from 6 months to 18 months before we actually go into recession.
Yeah, and the other distinction that's important to make is that recessions aren't all the same. And so you can categorize them as a severe or mild recession. And we look at all the previous recessions. Mild recession typically saw about 12 to 14% equity market declines, whereas severe recession was closer to 30% equity market declines. And so when we look at the factors that were similar across all these other countries, Poland and New Zealand, similar things that we have. Great household balance sheets, strong labor, demand for labor, essentially, wage growth. These are all things that can bolster the spending side of the economy. Same thing the U.S. has, and so we don't have a reason to believe that this won't be a mild recession. We don't have reason to believe that a lot of it hasn't already been baked into prices. And going through a recession is good in the sense that it can kind of restart a new cycle.
Yeah. But we still don't think that we're there right now.
Yeah.
It's somewhere out there. We don't see it in 2022, maybe more like 2023.
Right, yeah. But yeah, exactly. We're still kind of positioning portfolios to be able to brace against
that's right, on a more defensive area. Well, let's talk about consumer sentiment. Consumer sentiment is an interesting thing to track, because if you look back to the 50s through today, you look and see there have been 8 troughs where consumer sentiment is really low and 8 peaks where consumer sentiment is really high. And if we track the S&P 500 forward return 1 year after that either peak or trough, they're interesting numbers. If you look at the peak, those 8 peaks, the average return 12 months later in the S&P 500 is only 4%, a little above 4%. And if you track the 1 year forward S&P return, the troughs, it is over 24%.
Yeah.
So if you look at the difference, and right now, by the way, we're in the 9th trough since that period of time. So right now, when we look at what history has shown us, it tells us that 1 year out, very probably, we will see some good numbers on the S&P 500, but what's interesting on both of those, peak or trough, 1 year out, it was positive, but the trough, double-digit returns to the positive.
Yeah, absolutely, yes. And right now, consumer sentiment numbers are about as low as they've been through all these previous troughs, and it really is incredible what inflation did to the current consumer. A lot of people just haven't had to deal with it for so long.
So what we've been telling our investors is now is actually a very good time to invest, even though it doesn't feel good.
Yeah, exactly. And what you're just citing was the S&P 500 forward returns, and but that's not necessarily what we're recommending. Buying into broad-based S&P 500, or what we're going to be doing for our investors. Really, when we look at the S&P 500, the valuations are still fairly high. On a cyclically adjusted price to earnings multiple ratio, we're still right around that 30 times level. And when you look at history, when valuations have been this high, forward returns over the next 5-year period have been below average. And we're in a period where we're starting to see, we saw incredible earnings growth in 2021, like almost unprecedented earnings growth in 2021, and that's pulled back quite a bit. And we're listening to lots of earnings calls, we're listening to lots of management. They're all kind of saying the same thing. Consumers pulling back, we're pulling back. We're have to kind of tamp down on guidance and reel everything in. And so we're not looking at broad-based S&P 500 growth. We're being very selective.
Yeah. So a couple points there. What's amazing coming out of the last quarter is that profit margins were able to be maintained,
Mm-hmm.
which that was one of the things that we were looking at very carefully is could companies maintain their profit margins despite increased costs, both on inputs as well as on labor, and yet they were able to keep those margins. And now going forward to the next quarter, we'll be looking to see, okay, now what? Are they able to still maintain profit margins, or are we going to see more of a squeeze? When we divide the S&P 500 between companies that are have a greater than 2% dividend yield or a lower than 2% dividend yield, we see a large dispersion as far as PE ratios are concerned. And so where we see those opportunities are those corporations that have greater than 2% dividend yield with the lower PE.
Yeah, and that kind of segues into shareholders' returns, because when you are an investor in a company, you get returns in a few different ways. One way in which you get returns is the value of your stock goes up, and the value of your stock goes up either because the PE multiple gets bigger, and that's a sentiment thing. That's the market is getting more encouraged about the qualities of that company, the market in general. It's called multiple expansion. We don't really necessarily see a good argument for multiple expansion. The other one is earnings growth. Your earnings go up, and that can raise the price of your stock. We don't necessarily see a very strong argument for really strong earnings growth. But these companies are still making strong free cash flow. A lot of them are really making strong, good cash flow numbers. The revenue should be fairly resilient. And so, companies are beholden to shareholders, essentially. The management works for the shareholder team, the board, et cetera. And they can continue to deliver shareholder value through dividends and stock buybacks. And so that's another thing we're looking at. That's what Loreen just pointed out. We're looking at companies that are delivering that above average, above 2% dividend yield, and they are also happen to be companies that are fairly cheap.
Exactly. Another area that we really like right now is small cap. And part of that is that small caps got hit very hard in the first half of the year, and valuations look attractive.
Yeah, valuations are, we've had a little bit of a bounce back in recent weeks, but they're still about as bad as they've ever been. It's really incredible to see the valuation multiples, down around single digits for the S&P small cap index. And, we're looking at like 2020, 2008 levels where, it seemed like the whole world might stop. We thought 2008, financial crisis, banks would stop lending money. 2020, we'd be locked down for years. We're similar valuation multiples now with small caps. And so it's pretty incredible to see that. And so, it looks as though could be some great opportunities in smaller companies because they could bounce back really strongly. The one thing that we are cautious about is that their earnings are very high. And so, when you have such strong earnings, if you do go into a recession, typically who gets cut out is a small guy. And so we have to be really careful to see which small groups we're investing in to make sure that we don't get someone who's going to be too adversely affected.
And what speaks to that is, once again, active money management, being very selective, not going in with index, but being careful what those individual securities really look like.
Yeah, and we're finding companies in the smaller space. We're looking at companies that have basically zero debt in their balance sheet. They've paid off all their buildings, all their equipment, et cetera. They've got a backlog of customers. They're generating strong margins. We're like, hey, recession or not, we're going to keep producing for the next year or two, and and their stock's trading at great multiples. So yeah, we're encouraged by a lot we're seeing, but I guess the point of a lot of what we're seeing here is that we don't think it's broad based. We think it's selective. I think you have to be very active, very very specific to what you're going to.
And let's talk about what we don't like right now. We still are not going back in to the international markets. We're really keeping things much more domestic because it does look like, just given Europe, that they will be in a recession if they're not already in a recession fully, but they're going to have a tough winter with the whole issue of the reliance on gas from Russia and Ukraine situation. So with all of that, we are keeping the portfolios much more domestically based.
Yeah, and I've heard this 3 times in the past week that Germans are stocking up on firewood because they're worried they're not going to have energy. And yeah, I mean the valuations in a lot of both developed international markets and emerging look more attractive relative to our indices here. But like Loreen said, they're more at risk of recession. And there's other structural things about international markets. there are real growth players there, still have really high valuation multiples, and so it's just not really an area that we see, great to strike.
Yeah. And so let's close it out just talking a little bit about fixed income. On the fixed income side, we like quality, high quality fixed income, and starting to go out longer duration. And so what we're not really interested in is extending credit risk. We think that there's a better return on just looking at longer duration versus shorter duration, where we had been in the first half of the year, shorter duration, now going out longer, but not extending credit risk.
Yeah, once the Fed really starts to signal that they're at peak hiking, then that's when the longer end of the duration curve was really going to start to see their prices recover and come back. And we're at, for long duration fixed income, some of the worst year-to-date pricing in the history of those indices. And so these, bonds are simple mathematical, functions. If the Fed starts to show their tapering back, they will get repriced. They will come back up. And so, like Loreen said, really we can go down two paths. We can choose to, or do one, other, or both. We could go down the duration side. That's where we think that we have more confidence that prices will come up. On the credit side, spreads are okay. They're not looking great. Spreads are basically how much you're going to pay for that risk. Every indication is that we're going to continue to see more defaults. We're going to continue to see more downgrades. And where spreads are now, it just doesn't really seem like an area of risk that we're really jumping at the bit for.
Exactly. So with that, we want to remind you to please give us a call. Go to our website, wealthwisefinancial.com, and please contact us with any questions.
All right. Thank you.